So for those that don't know me, I'm Rob Jupp. I'm the CEO of Bright Star Financial. In my day job, I run a UK specialist distributor. I've spent my career in the specialist market, and it's been one hell of a roller coaster, which I'm going to share with you over the course of the next 45 minutes to an hour. There's a few things in life that I think I'm pretty qualified to talk about. The first one would probably be beer. I'm reasonably good at beer. I'm reasonably good at beer labels. The second one would be Brighton and Hove Albion Football Club, and I'm guaranteeing I'm probably the only person in the whole event here that's a Brighton and Hove Albion football fan. And the third thing was another one there. Thanks very much. Two. Well, that's percentage-wise, that's almost 10%, I would say. That's brilliant. And the third thing is the specialist market. The reason for that is a very, very brief potted history of me. Someone once described my career as like a road traffic accident, which was slightly insulting, but at times probably quite true. So in the mid-90s, I got involved in specialist lending with the new centralised lenders, the likes of Kensington and Future Mortgages and others. And it was a small sector in number. In the early 2000 to 2007, I got heavily involved in the specialist market. In fact, in June 2007, my business at the time became the largest originator of non-conforming debt in the UK that month, when we originated just over £100 million worth of first charge mortgages. So life was great in June 2007. What could possibly have gone wrong? Some 14 months later, on September the 14th, 2008, the World Global Bank that was too big to fail failed, and the rest is history. Unlike some of my peers, I didn't go and do something more interesting, I don't know, selling overseas property or something. Stupidly, I decided to stick with it, or so I felt at the time, and the next couple of years were really, really tough. And just as things started to get really tough in 2010, I decided I wanted to not be a safe employee where I was at Savills, and I would go and start another business in the worst lending market in a generation, some would say in history, and some will say probably ever. So that was a brave move, and I think the current Mrs. Jupp looked at me in a slight nervous way and did feel perhaps at that point I was having the first of a few nervous breakdowns. But I'm pleased to say 2.5 years later, my business isn't just surviving, it's thriving. And I think that journey is a journey that I hope a few people here are on also. So that's me. The presentation today, we're going to be looking at a number of things. We're going to be looking at some of the math connected with the timeline of the rise, the explosion, the destruction, and the gradual re-emergence of the specialist lending sector in the UK. And I'm going to use 3 dates to talk about. I'm going to look at 1999, that many would see as the start of the new era. I'm going to look at 2007, that we would all agree was the top of the market. And I'm going to look at 2010, which we now know was the bottom of the market. We're going to talk about the consequences of a vanilla-only mortgage market. And there are tremendously negative consequences for UK PLC. And it's important that we look at that and say, actually, this sector isn't just a sector that we need for income. This sector is a sector that we need for the survival and the fabric of our very society. I'm going to briefly look at current opportunities for mortgage intermediaries. Now, if I'd have done this presentation 2 years ago, 3 years ago, it would have been very much about what might happen. I don't think that's really relevant right now. We need to talk about what's happening now, where the opportunities are, where are some of the income areas. And for those of you that maybe aren't in some of these areas, perhaps a bit thought-provoking to see what you could be doing. And we'll look at that. And this is key. We'll look at what needs to happen for us to have a return to what is a market normality. And we'll look at some of the factors that could positively influence those, and we'll look at some of those factors that could absolutely derail that recovery process. So, 1999, I would call that a predictable market and a lack of innovation. Anyone that was responsible within the CML for predicting mortgage stats got an easy job. You just increase it by 5% every year. And the average client looked probably something like this couple. This nice, safe family couple, the nice nuclear family, nothing exciting, nice and safe, nice and predictable. So what did the average mortgage advisor look like? Well, I think they looked a bit like that, actually. And for those of you who don't know this gentleman, he is the whole description of predictable and lack of innovation, is the current England football manager, Roy Hodgson. So, the stats were, it was a small sector. 6% of all mortgages done in the UK in 1999 belonged to the specialist market. And you compare that with the mutual sector that stood at 23%. So here we go. And a tiny, tiny figure. RMBSs and covered bonds stood at just 13%, 13 billion per annum. So in these years, this was a bit of a party, 2000, 2007. I call it the mortgage revolution. And let's look at some of the figures of what the average client looked like and what the average mortgage advisor looked like. Now, the average client, those nice, predictable, safe people were still there. They're not going anywhere. They're always going to be there, we hope. But they were joined by this nice, ambitious, dynamic set of people called first-time buyers that were buying property in the UK in greater numbers than ever before. Buoyed by such schemes as the Northern Rock Together and others, more first-time buyers renting the market. And there was this new group of people, the John Barneses and the Carrie Catonas of the world. Has anyone got a clue what those two people have in common? They're bankrupt. They were bankrupt. So all of a sudden, you didn't have to be a normal, straightforward customer. You can have some CCJs, you can have some defaults, you can have a story. There'd be lenders out there that would lend to you. And what happened is home ownership rocked to the highest point in history as a result of that. Mortgage advisors, what do they look like? Like that, I reckon. Don't see many faces like that at the moment, I have to say. You know, it was a great job to be part of. A great industry. The sort of industry that your son or daughter, you'd say, follow mum, follow dad. It's great. Advisors' incomes were great, and as a result of that, the amount of advisors reached an all-time high of just over 30,000. That figure we were talking about a little while ago, at 16 billion for covered bonds and RMBSs, went up to £257 billion per annum in just 8 years. The top of the market, the magical 362 figure, 63 billion went to the specialist market. And this next figure's interesting. Of net lending, so net of redemptions, the market in 7 was 108 billion. Look at that figure. 81 billion of that was in the specialist market. This market wasn't just buoyant, it was the engine room of the industry at this period of time. And in CML stats, 7 of the top 30 lenders were specialist lenders. You had GMAC RFC in 7 I think number 12 was the highest, and you had G and others behind them. What could possibly have gone wrong? So, the American investment bank, Lehman Brothers, too big to fail, failed on the 14th of September 2008, which was 4 days after I'd sold my business to Savills. So you can imagine they were very happy about that. What did the average client look like? What did the average mortgage advisor look like then? Well, I've got to say, the nice, safe, first-time buyers on the sofas, even they disappeared. You had to be royalty to get a mortgage. And actually, even if you were royalty and you were a broker, you would be cross-sold galore. Dual pricing was ridiculous. I do hope some of you intermediaries out there won't forget some of that behaviour, because it was appalling. And the average mortgage advisor looked a bit like John Terry when he missed the penalty in Moscow in the pouring rain against Manchester United. It was a horrible job. That job that we would recommend to our children, absolutely do any job, but don't become a mortgage advisor. In 10, we're up the heady heights of the 165. Only 7.5 billion of all lending was to the specialist market. And remember, lenders like Paragon, their figures would be in that as well. So it started here, it went right up through that roof, and it came crashing down. We're talking about 2009 to 2010, just 11 years, just over a decade. So, there's some really alarming statistics here. The first one, Home Owners Alliance, the source. The peak of home ownership, 2002. 69.7% of the UK adult population owned their own property. And as a result of the period, remember, not up to 2007, but post 7 and 8, that figure has reduced to 64.7%. Still feels a high figure, but feel where the market was in 07 to where the market is now. That deterioration is as a result of the last 4 years, not the previous 5 years, the last 4 years. So less people are able to buy homes, right? Supply and demand. Simple economics. If people can't get mortgages, they're forced to rent. What happens to rent? Rent goes up. Home Rental Index, June 2013. Rents are at the highest point in history. Rents are at the highest point in history. If you wanted a rent on average in the UK, the rent was 811. And if you're unlucky enough to live in the Greater London area in the South East, that rent has gone up to 1,260. In 1 year, rents have gone up by 5.1%. This is key. You'll hear people talking about this time and time and time again, and next to nothing is being done. The UK is an island with a growing population. We are not building enough houses. We build, on average, for the last few years, 100,000 a year. We need to build at least 250,000 just to keep still. Rents are increasing, mortgages were harder to get, but incomes aren't going up. In the same time as rents went up by 5.1%, average incomes only went up by 0.8. Average salary in the UK is £28,000. Average rent in the UK is 811. And for me, the most worrying statistic of all of them is that the houses that we've got in the stock, the housing stock we've got in the UK, or getting worse. Shelter, in a recent study, said there were 7.4 million homes in England alone that fail to meet basic government standards. That is an election winner or an election loser of massive, massive proportions. So, despite all that negativity, what are the opportunities right now? Well, I've thought about a few here, and I thought about a few based on my business and the sort of inquiries that we're getting that we are helping to make a difference to intermediaries right now. The first one is that group of clients that have unusual incomes. Now, that could be those that are self-employed. It could be those that are recently self-employed. It could be those that have got poor accounts for a period of time. It could be those that work offshore and get paid in different currencies. It can be those that, for whatever reason, get a relatively modest basic salary, but their on-target earnings are very good. Most of those type of people will not get mortgages with the high street. Now, there will be exceptions, but most of those people will not get mortgages with the high street. And the mutual sector has led the recovery here. And in the last 2 years, lenders like Saffron Building Society, Kent Reliance, Buckinghamshire, and others will lend. They're not lending irresponsibly, but what they're doing is they're taking the time to understand the dynamic of the client. So if someone has got poor accounts, call me old-fashioned, but the first thing I ask is why? Because there will be a reason. And it doesn't follow that they are struggling as entrepreneurs. It could be that they bought a piece of machinery, it cost a load of money. That when we look at the accounts, the projections for the following year, you're going to see that. It might be that they're a property business that wrote down assets in 2008 and are carrying forward the write-down still. We've got to understand it. Unusual properties. So you've got to be pretty straightforward to get a Santander, Halifax, Nationwide, Woolwich mortgage. If your property is a bit unusual, and by that, I mean there might be a restricted covenant in place that means that a certain type of person can buy it. It might be, as in vast swathes of West London, that it's got a really short lease, because that's what happens there. It might be that you've got a farm in Mid Wales, and you don't farm it, but you've got a farm with a lot of land. And lenders will say, okay, we're not doing it because there's too much land. Bizarre, absolutely bizarre. Deals are being done today, yesterday, and tomorrow for people like that. I get sick and tired of hearing people slate the short-term lending market in the UK. And the reason for that is I remain passionate about it. The reason I remain passionate about it is I look at the state of the UK economy, and I think without the short-term lenders in this market, where the hell would we be? Short-term lending provides a solution to business finance that is not there now. A lot of the short-term deals that we do, that our lenders do, that intermediaries do, are deals, in my opinion, that should be being done by the high street. But they're not, because they don't fit the risk profile of the risk officers. Anybody that thinks that short-term lending is a road traffic accident waiting to happen is simply misinformed. Out of that sector will come the gradual re-emergence of names in the future that will be regulated first charge mortgage lenders, because they're run in the main by entrepreneurs that are free-spirited, that know what they're doing. This is a big market, self-build. We're an island, we've said that. We're a tiny island with a big population. The amount of people that come to us and say, I've got this simple plan. I want to build a house. I've got a big garden. I've spent 3-4 years getting planning permission, and I want to build my own property. And they go to the high street, they go to their bank that they've been banking with for years, they've had a mortgage with for years, they've never defaulted. These clients are super vanilla, and they can't get mortgages. As soon as that property is completed, the reality will be, for most of these clients, they will either reduce their total indebtedness significantly or entirely completely, and they'll have a property unencumbered in a lot of cases there. These are people that aren't doing things speculatively to make money. These are people that want their own dwelling, to their own design at the right time. It's a great, great, great marketplace. From small conversions up to grand design properties. If it's done correctly, the loan to value at the end is almost always below 60%. Secured loans, there's not a week that's gone past, for the last few weeks certainly, where there's not been another secured loans lender launch. And we're pretty excited about that, because all the time first charge lenders are getting stuffy about assisting clients with more debt, because they can. All the time there's a hidden agenda with some lenders to try and get clients off base rate tracker products, because they didn't believe and didn't realise that there'd ever be a reversionary issue with their 0.23 over base. And all the time there's the odd urban myth that the FCA want to eradicate interest-only mortgages. Second charges are great value for money. Not right for everyone, but right for a lot of people. And very, very good average incomes. And, God bless it, my old friend, the non-conforming mortgage. There's no non-conforming mortgages lenders in the UK now, right? Rubbish, there is. GE have lent their money, their American money, all the way through the downturn. Precise are lending their money at good margins right now. Magellan Home Loans formed 3 weeks ago. To qualify for that product, you have to have adverse. If you haven't got it, you can't have it. Bizarre. And a range of small mutuals. They don't make a song and dance about it, but they are lending. So, there is an active marketplace for that. It's not huge, it's not up at the 85 billion of net lending as in 2007, but it's there right now. But, and there is a but, we're going in the right, if this was a school report, we'd be going in the right direction. But trust me when I say that this is a train that could be derailed really easily, really quickly. Now that's always been the pariah, hasn't it? The FCA, the FSA. At these sort of events, the best attended event is the regulator's speech. And it's almost like a peasant in 1780 in Paris with a guillotine. What are they going to say that's just going to create even more chaos? I worked with the FSA, as it was then, on CP 1131, which in October last year became PS 1216. I have to make reference to it, because what's that? That's the Mortgage Market Review. That was a document that for 2 years made lenders change unnecessarily because they were thinking about what might happen. What might happen wasn't actually what happened. And the view is, with most lenders, intermediaries, industry commentators, the Mortgage Market Review has got nothing scary, frightening or sinister. On the 1st of April, the FSA died, and I was lucky enough to attend a meeting there in my capacity as an exec committee member of the AOBP. On the 4th of April, and all the colour scheme at Canary Wharf had already changed. And the FSA died, and the PRA and the FCA, under the direction of the HM Treasury, changed. Do you know what the bizarre thing was? I went to a meeting in March with the same people. I went to a meeting on the 4th of April. And the change of culture in just weeks was remarkable. This is the baby that worries me the most. Brussels. There's something called the CARRP. Again, I'll make reference to my notes, which is the credit agreements relating to residential property. It's the EU Mortgage Directive. Brussels, in common with a lot of their practices, are intent in making the markets, the economic markets of EU nations the same. Commonality right across the countries, the member states. And actually, well done. It's the UK team that for 2, 3, 4 years said to the EU ministers, we want to change. We don't want what you want. And they got a carve-out. They got a carve-out for buy-to-let, as you now know. They got a carve-out for equity release. Offset mortgages, they would have gone overnight. Carved out. UK allowed to do them. Also, next year, KFIs were dead and buried. There was going to be something called the European Standardised Information Sheet. That just fills me with horror. But UK negotiators carved out a deal. It's not coming in 2015, it's coming in 2020. Mr. Cameron has made a pledge that if he wins in 2015, late 2017, there'll be an in-out vote on whether to stay in the EU. So that is a work in progress. That still is concerning. We've made progress, but that could still derail UK PLC and the specialist market. However, with less than 2 years to go before the next general election, the biggest challenge remains our own government. I sat in my house on Saturday evening with absolute horror that Help to Buy was being moved not back, but forward for a quick political gain at the Tory party conference. Now, the latest polls are that if there was a general election today, Ed Miliband and the Labour Party would have an 11% turn in their favour, which would be a 100-seat majority. The incumbent coalition is in trouble. What do? They get the economy looking good, and they get people feeling good by doing what they haven't been able to do, which is to buy property. I've got a quote here by Ed Balls. And I'm no secret red, guys. But at the Labour Party conference, he said something reasonably profound. George, it's basic economics. If you push up housing demand but don't boost housing supply, all that happens is you push house prices up and up and up. And the end result is that the very people your policies should be helping, i.e. young first-time buyers, will find it even harder to get on the housing ladder. Home Track on the 30th September, just a couple of days ago, stated that house price inflation in the UK is increasing at the highest level since 2007. So what do? We encourage it even more by a misguided, misthought policy. The funding for lending has been excellent, and the cost of money is now at a low because of the funding for lending scheme. So they have got a few things right, but that, in my humble opinion, is the ultimate housing policy disaster. And what happens every time the government try and get involved in the housing market, they balls it up, and you can quote me on that, because they've done it several times before over the course of the last 20 years. Now, again, maybe being a cynic, the economy looks great at the moment, doesn't it? Some more headline stats here. Consumer confidence is at its highest point for 4 years, according to NOP. What does that mean? It now means that minus 13% of consumers feel confident, and that's the high point. Unemployment looks like it's coming down, 7.7, up to September. Inflation steady at 2.7 in August. Interest rates linked to unemployment going below 7%, so a period of normality. And the Eurozone appears to have sorted itself out. We've had Greece, we've had Portugal, we've had Italy, we've had Cyprus, we've had Ireland, and all we've got to worry about now is America, because that looked like it was all fine until 2 days ago. So, the economy looks like it's going in the right direction. But, there is a general election in 2015. Any person that studied economics for the last 5 or 6 decades will tell you that 2 years before a general election, things start looking positive. It's no surprise. And this is key for me. Innovators. Your Kent Reliances, your One Savings Bank, your Buckinghamshires, your Saffrons, your Precises, your Magellans, your GEs, and others. They need to be able to succeed. They need to be allowed to show conventional markets that the specialist market is not evil. It's good, it's safe, it's normal, it's universal. Our regulator needs to allow those sectors to be responsible and not judge that they're clearly not responsible. But for things to get better, that has to be a high street word, a name on the street, securitisation. The market will not recover all the time there is not an active market for mortgage-backed securitisation in the UK. In the next 5 years, a study in Eurozone finance has said there's a €4 trillion gap in funding. And the only thing that can bridge that gap is securitisation. Remember those statistics we were talking about right at the beginning of securitisations back in the day? I'll remind you of those. 2007, the residential mortgage-backed security market, RMBS and covered bonds, £257 billion per annum in the UK alone. Securitisation's dead, right? Absolutely not. October 2009, Nationwide did a 3.5 billion issuance. Our RBS, 4.2 billion. LBG, 4.5 billion in the bottom of the market. What needs to happen for that to happen is that we need to forget and understand why there was no market for securitisation. If you allow ratings agencies to make the decision on whether something is good or bad and incentivise them for making things good, they will make it good. And since then, there's been a micro market for services, mortgage services, that will do basic due diligence on portfolios. Did the American investment banks know what they were investing when they bought RMBSs in 2007? No, they never did. Oh, we got a $500 million issuance here, and it's full of a load of subprime clients. But, you know, Fitch has said it's a AAA rated. Well, look at it. Would you buy a car without knowing what the engine was about, without looking at its service history? You wouldn't. So why did we? Absolute madness. So securitisation is back. We need to understand if you're securitising non-conforming assets, you need to say that you are securitising non-conforming assets. Not call them AAA rated prime, because they're not. Because they won't perform like prime assets. They'll perform like non-conforming assets. But you pay a premium as an investor as a result of that. So absolutely key. Whatever happens with all of those other factors, if that last one does not happen and grow, then the market will remain where it is right now. 185 billion. Next year, with Help to Buy, maybe the heady heights of 200 billion. Maybe not 10,000 mortgage advisors, maybe 12,000. But we're not going to be Ronaldo and Gareth Bale, are we? We're still going to look and feel a little bit like a cross between John Terry and Roy Hodgson. So, for me, if I'm a weather forecast to describe my view of the business, I would say right now, we're out the storms, but we've still got some pretty heavy cloud there. There's a few little gaps of blue, but the temperatures aren't rising too much. And what Help to Buy will do for the specialist market, I'm very, very sure. It will do nothing. It won't touch it. The sort of customers that require specialist mortgages will not be helped by Help to Buy one iota. It's the sort of clients that, frankly, will be able to buy property anyway. They just won't have to save quite so long for that property. So it is positive stuff, but there's going to be no quick fix. We have to keep our nerve as a sector. We need to work with innovators. We need to challenge innovators. If the pricing structure is too rich, we need to tell them. And we need to get lenders perhaps to link together a bit better. So I think in conclusion, the last 5 years has aged me certainly 10 years, probably 20 years. Probably going to put me in an early grave. But I have so much enthusiasm and passion for our sector right here, right now, because you know what? You've got to look out there right now. You've got to look at the amount of specialist lenders that are coming to these sort of events. You've got to look at the fact that there's not going to be one event now, there's going to be 3 in the course of the next 4 weeks. Things are looking reasonably positive. How are we doing for time? We almost there? Okay, all right. We've got a bit of time left. So does anyone have any questions they want to ask? Because I've got a bit of time, I'm happy to answer anything you throw at me, if I can. Can you get a microphone here so we can...
Hello, sorry. I think you're right, there's a massive opportunity here for both prime, residential and specialist. Concern I have would be, are a lot of the people that were in the packaging arena that weren't the greatest brokers in the world seeing this as the, I suppose, the dripping roast and moving into it? So is the quality of advice going to be as good going forwards as it should be? Because we've seen massive regulation and massive changes in the residential market, but is this an opportunity that the guys that just aren't really up to it to try and earn more money very easily?
I think that's a concern, Chris. I think that is a concern, but I'd come back to you and say I have the same concerns about the mortgage intermediary market. That 35,000 strong. Were there people there for the wrong reasons? Well, I think there was. So I think yes, with a slowly maturing, developing market, there will be new opportunities. But remember, 2000, 2007, the explosion was like that. So people that had no background in financial services and mortgage lending, that perhaps were, I don't know, I can think of one that was selling cars. Not going to sell cars anymore, not making enough money. I'm going to start working in non-conforming. The FCA have got a pretty decent handle on our sector. And they're talking about we want to make sure specialists and packagers don't give advice. And I think that's absolutely key, because that is a concern. But that's so yes, I think it is a concern, but I've got the same concern for mortgage advisors, particularly with a lot of the high street estate agency chains as well, that employ kids a lot of the time.
I think it's an issue across the board, because if you run a business, the big issue at the moment is trying to recruit staff.
Yeah.
Because we're all fishing in a very shallow pond, and there's no doubt about it that the business is there, it's growing and it's getting better, but is the desire to recruit going to overlook the desire to recruit quality? And that could be a problem for all sectors.
Yeah, I agree.
So I think it's a concern that we need to be aware of as business owners. And I'd say
it's the same concern that we have about conveyancers, about valuers, the whole process. Thanks. Can we, just grab a mic? Thank you.
Sorry, thank you for that. It's a good update, especially in the context of what else has been discussed in the last 2 days. Where do you position yourselves? Because on one hand, you're mentioning the percentage that fall below the decent home standard, so there's an opportunity there for improvements, whether paid for by the occupiers, owners, or the social housing sector or anything. But I plug into the green stuff as well. So I'm aware that in the last year, since the launch, there's only been 12 Green Deal cases in the UK, which is appalling, considering, and I've got some insight into why. But I'm trying to join up the dots in terms of the non-conforming, which, as you say, is a huge opportunity. And I can tell you the securitisation is coming because it's already evolved in the commercial and other sectors.
Agreed.
So where do you position yourselves in this marketplace? And what do you want from, essentially, the broker community out here?
Well, we straightforward, we position ourselves where we feel we can make money, where we can add value. And we don't position ourselves as a business, as a mortgage club, because we don't add value there. We simply add value in areas where brokers are saying to us, you know what, I haven't got the resources. I'm too busy doing conventional conforming mortgages to actually upscale my knowledge in those areas. So I think it's market forces. We'll just do what we need to do in a sector that we can make money in. Simple as that.
I'm asking because part of the demand for homes had been stalled by the lack of finance for the builders. The big boys are taking care of themselves, but in the middle market, a lot of developers haven't recognised that where their traditional sources of finance aren't what they were, and have taken a while to learn that most of the bridging and packages are using private finance, and that's where the money is for what they want to do. And there's a gap and a lag there, which I'm much more plugged into than the pure residential stuff. So.
I know of one hedge fund, UK-based hedge fund, a multi-billion-dollar hedge fund that was getting involved in reassurance because they thought that was the market to be in. And now are actively looking to recruit a team in the UK for specialist lending, right here, right now. And the sort of quantum they're talking about, 100, 250 million in their first year of launch. And Magellan, that's a big, big cultural shift. A non-conforming lender that you have to have non-conforming debt. Really bad stuff as well to qualify. Took me a bit of a while to get used to it, I have to say. Thank you for the question. Anybody else? Phil.
Hi, Rob. Is it likely that a combination of the good work that you do and a likelihood that non-specialist lenders will become more interested in this arena, that the specialist industry is doomed to become less specialist in the possibly quite near future?
Yeah, I agree. I wouldn't use the term doomed. I think that's just simple evolution. You know, if there's a sector that is safe, that has higher returns and beats better margins, why would the high street not follow suit? But I think we are way, way, way away from that right now. I think you've got half a decade, that long, actually, before that's an issue. Right, thank you ever so much for attending. I think it's been a really well-attended event, and enjoy the next few hours at Expo. Thank you.